This is a presentation on Chapter 13, Stockholders' Equity, and now we're going to cover Learning Objective 2, which is journalizing the issuance of stock. So we talked about in the first presentation that corporations accumulate more capital than other businesses, and they do that by issuing stock. So there is a process, of course, for doing this. Most of the time, the company is going to sell its stock either directly to the stockholders or it's going to use the services of an underwriter. So an underwriter is just usually a large financial company like Goldman Sachs that markets shares of stock to the public. Now, the underwriter can assume some of the risk involved in issuing the stock by agreeing to buy the stock if all of it doesn't sell. So there are just different ways of handling the risk involved in issuing stock. But now we're talking about public corporations that are issuing their stock on probably a stock exchange such as New York Stock Exchange or NASDAQ. So when the corporation issues the stock, they're going to set a price. So that's part of what the underwriter is involved in, is determining, getting an idea of what the issue price for the shares of stock will be when they're first sold to the public. We're going to talk about in this learning objective about how to account for the issuance of, first of all, common stock. So in the first presentation we talked about par value. So again, par value is just an arbitrary amount, usually low, that the corporation assigns to each share of stock in the articles of incorporation, and that becomes what is called legal capital. So in the first example, we're going to look at Smart Touch Learning selling 15,000 shares of their par value stock for $15,000. So they're selling it for $1 per share, and that is also the par value. So we recorded these types of entries in Principles 1, and all you would do is you would debit cash for 15,000 and you would credit common stock for 15,000. So $1 times 15,000 shares. Now, as we said in the first presentation, common stock is usually sold at more than par value because par value is intentionally set very low. So in this example, we're going to look at the journal entry to record the sale of 3,000 additional shares, but this time the shares are going to sell at $5 per share. So now we're going to divide up the amount that we received for the sale of the shares into legal capital, common stock, which is going to be the par value times the number of shares, and then a different account which we talked about before, which is called paid-in capital, in excess of par. So 3,000 shares were sold and the shares have $1 par value. So we would debit cash for the total we received, which would be 3,000 times $5 or $15,000, but common stock would only be credited for $3,000, which is $1 times 3,000 shares, and then the difference between what we received, 15,000, and the 3,000 par value would be credited to paid-in capital in excess of par, and we do add common because especially if we have preferred shares. So that is the debit and the credit when the shares of stock are sold for more than par value. Now we're going to look at stockholders' equity for Smart Touch Learning after these two issuances of common stock were made. So we can see that first we have common stock listed, which is going to be the par value for the 18,000 shares that were issued and they're outstanding. So that would be $18,000. Then the difference between what we received and the par value, which in this case would be $12,000, is going to be shown as paid-in capital in excess of par common, We add those two together to get total paid-in capital, which would be $30,000, and then we're just going to assume that they had retained earnings of $3,550, so total stockholders' equity would be $33,550. Now, what happens when we don't have a par value? And we talked about that some corporations just don't have par on their shares. So when they issue their shares of stock, all of the proceeds are going to go to legal capital or common stock. So again, if we had issued 15,000 shares for $1 per share, we would have a journal entry to debit cash for 15,000 and credit common stock, no par value for 15,000. But if we issued 3,000 shares for $5, this is when it would be different from the entry we saw before. So if there isn't a par value, we would debit cash again for the 15,000 and common stock for the whole 15,000. So again, when there is no par value, the entire amount of the proceeds would be credited to common stock. So now when we look at the stockholders equity section for Smart Touch Learning, we can see that the paid-in capital section would only consist of common stock, which would be for the whole $30,000. There is no additional paid-in capital shown when you have no par value stock. So we would have only common stock, retained earnings, and then our total stockholders' equity would be the same amount. Now, if we issue stated value common stock, which we talked about in the first presentation, stated value is when you have no par stock, but you give it a stated value. We treat stated value just like we treat par value in terms of doing the journal entry. So using that example of Smart Touch Learning issuing 3,000 shares of $1 stated value stock for $5 per share, we would debit cash again for 15,000, 3,000 times $5. We would credit common stock for the $1 stated value times the 3,000 shares, or $3,000. And we would credit paid-in capital in excess of stated common for the difference between the proceeds of $15,000 and the $3,000 of legal capital, or $12,000. We can sometimes issue common stock for assets other than cash. So when businesses are getting started, they typically will go into business maybe as a sole proprietorship, but then they'll organize later as a corporation, and they'll transfer the assets from the sole proprietorship into the corporation. So for example, let's say that Smart Touch Learning received furniture from the owner instead of cash, and the market value of the furniture was $18,000. We would make a journal entry where we would debit furniture for $18,000, because now that furniture belongs to the corporation and should be on the corporation's balance sheet. And then we would credit common stock if it's $1 par value, and we gave 5,000 shares in exchange for the furniture. We would credit common stock for 5,000, and then we would credit paid-in capital in excess of par common for the difference between the $18,000 market value and the $5,000 par value, or $13,000. Now it's important to make sure that when you're valuing assets other than cash, that you either use the market value of the assets that are received or the market value of the stock, whichever is more clearly discernible. Normally, if the stock is being traded, then we're going to value the transaction at the value of the stock, but that's not always the case. So sometimes you would value it at the assets. Now we're going to look at how do we record issuing preferred stock. So we actually treat preferred stock just like we do common stock. Preferred stock has normally going to have a par value, and so we're going to have an amount that we're going to credit to preferred stock, and then any difference between the issue price and the par value will go to paid-in capital. So in this example, Smart Touch Learning issued 1,000 shares of $50 par value 6% preferred stock at $55 per share. So how much money did we receive? We received $55,000, which is 1,000 times $55. So we would debit cash for that amount, and then we would credit the preferred stock for just the par value amount. So $50 times 1,000 shares would be 50,000. Now the difference between the amount that we received, 55,000, and the credit to preferred stock would be credited to paid-in capital in excess of par preferred, so that amount would be $5,000. Now we'll look at stockholders' equity for Smart Touch Learning after issuing the preferred stock. So if you notice in the stockholders' equity, preferred stock is actually going to be listed first before the common stock. And the reason why is because, as we said earlier, preferred stock has preference over common stock to the assets upon liquidation. So it's just convention that they're shown first. So we can see that we're going to show the par value for the preferred stock first, 50,000, then the paid-in capital in excess of par preferred, and then we'll list our common stock and our paid-in capital in excess of par common. Now we would add all of those together to get total paid-in capital of $103,000, which we would add to retained earnings, and that would give us total stockholders' equity of $106,550. And that is the conclusion of the demonstration for Learning Objective 2.